What's up, everybody, and welcome to the Financially Free Era podcast by SLP Wealth. I'm your host, Megan. Today, we're going to do something a little different. We did a webinar recording right before Halloween. We called it The 7 Spooky Mistakes DIY Investors Don't Realize That They're Making. And both Travis and Conor, our Chief Investment Officer here at SLP Wealth, and Travis, of course, our CEO, they nerded out about these investor mistakes that they commonly see with folks who do a lot of their investing on their own. So I thought it would make for actually a really good podcast episode as well, just broadly to talk through those common mistakes that we see, how to avoid them, what we do to avoid them or diversify those risks out. So this will be a little different from that perspective. For the most part, I think you'll be able to follow along without having anything to look at. It's pretty verbal as they were talking through these concepts. But hopefully you find this helpful if you are a DIY investor yourself, or if you were thinking about being a DIY investor. This could be some things that you need to watch out for, and why working with someone on your investments, working with a financial professional can be really helpful and save you money in the long run. So without further ado, I'll turn you loose to listen to Conor and Travis.
All right, Conor, we're going to talk about some investment stuff today. I'm excited. We got some pretty juicy technical stuff to share with people, but also some high-level funny stuff to be entertaining to people. I'm so amped to share some of this work that we've been working on. I think people will enjoy it. I think it'll be fun for people to look at.
Yeah, I think so. We're gonna share some scary stuff. Some scary stuff if you're DIYing your investments. How to avoid. These are like the classic horror figures from horror movies. Like, how do you not trip and fall when you're running away from the killer? That's hopefully our webinar.
Oh yeah. And so I'm going to highlight this thing we've been working on called the mega spreadsheet, for lack of a better term, right? So we've been putting together some of these investment mistakes we commonly see people make. And I thought, maybe it would be kind of a cool thing to work through these 7 spooky mistakes to make sure people don't make them, right? So the thought of these 7 kind of spooky mistakes, right, is I was thinking through this paper. This paper's linked here. We actually can get, we give out this mega spreadsheet. So if anybody needs this copy, I can send it to y'all's emails like later today. I could just send a copy if people want to look at this themselves. But basically, Vanguard and MIT came out with a paper, Conor, that looked at like what are the most common DIYing and investment mistakes that are made, and what is the annual performance impact, and how much does it cost people, right? And I thought that it'd be kind of cool to build like a green, yellow, red traffic light style system to dive into like these performance mistakes and, why people make them, how they happen, and just to talk through like how to avoid them and what are some ways to avoid them, right? So green means that there's a low risk that our educated clients would make this mistake. Yellow means these mistakes we think people would be kind of likely to make. And then the red is extremely likely for these mistakes to be made. So if we want to just talk through like each of these, let's maybe just go one at a time. I'll talk the technical stuff, and you actually have made an analogy of what Halloween horror character each of these is. So yeah. I mean, maybe to keep this entertaining, we can just talk through like the technical stuff and then talk about like what your analogies are to keep people excited and engaged for the webinar today.
I love it. Yeah.
So investing in a low cost way, we think most of our clients, this is like avoiding the 1% active mutual fund, right? Or, this is a lesser known thing, but not putting money into like a small ETF with a really high bid ask spread. That's like, something that people often mess up. If you're trading in thinly traded securities, you can incur a really high, basically, for lack of a better word, commission for getting in and out of those kinds of investments, right? So can you identify large funds or ETFs? And can you identify ones that have low expense ratios? I put this in green because most of our clients do this. Most of our clients can identify this with a little bit of education, right? Now, what was your
on that?
Yeah, go ahead.
I would add the custodian that you invest at as well is really important there, because depending on what kinds of funds you use, you may have commissions, and that's less common nowadays. But I remember using, VTSAX used to be kind of like a kind of a no-no at other custodians, right? They charge you a commission every single time if you put $100 a month in there.
Yeah.
Yeah, so that's another thing to keep in mind. But I consider this one, uh, this is basically Jason from Friday the 13th, right? He's slow, he trudges, but he's always there. He's always coming after you. Not hard to get away from, as long as you're not in a horror movie.
So we're gonna say, will you? Are you doing this? We'll select yes for this because most people I think are gonna do this, right? Now, this next one, avoiding market timing. I think a lot of people think that they never market time, right? They are like, oh, I buy and hold forever, I never sell, right? But the reality is, if you look at the data, that's not really true, right? Like if you look at the data, people do tend to make selling and buying decisions at the worst times. And it's not just going all to cash. It's also like you have a recurring investing contribution going, and then there's a bad recession and you slow it down or you pull it back, right? Or alternatively, the market's on fire, you haven't been investing a whole lot and you rapidly increase your contributions, not thinking about, is this something that's going to be sustainable if there's a market crash, right? So I think that people both on the upside and the downside of market swings make that market timing sin, for lack of a better word. And if we're honest about it, we're all humans and we are all prone to this. And it's not just market timing within stocks and bonds, it's also different asset classes, right? So if US stocks are doing really well, people pile into US stocks. If international is doing well, people pile into international. If crypto is doing well, people pile into that. So this is Vanguard estimates this is a negative 1.5% annualized hit to your performance if you do some of this mild market timing. And I've got it in yellow because most people are going to engage in this at some level, even if it's just reducing their automated contributions over time, right? So who's the Halloween character for this one?
This one is Freddy Krueger. And the reason for that is I think some people approach market timing with they have a dream of what market timing can get them, right? Avoiding the bad, keeping the good. And, the worst things come for you in your dreams. So this is Freddy Krueger. I would add also, or I guess a question for you, Travis. Do you have can you think of like a specific example of market timing? Or I have one in mind, like COVID, for instance, right?
Well, yeah. I mean, so think about a really stressful time in the market or really a buoyant time in the market and ask yourself, what did you do? Right. So like I was thinking about the end of March of 2020. That was a period where everybody was wondering, is the world collapsing or not? Right. And the stock market was going down 3% every day, it felt like. And the question is like, what did you do during that time? Like, did you pile out of stocks or did you not invest? I mean, not taking action is also market timing, right? Not doing something is also like it's a sin of commission and omission, right? There's two different kinds.
Right.
And so that would be a sin of omission in investing is not backing the truck up or at least being open to putting, cash, that you have available that you don't need for emergencies or goals into investments at times that felt scary. So this is some people might say, oh, I do this or I avoid market timing. Some people would say, are you doing this? So a lot of people would say, yes, I feel confident. I'm not going to market time, right? Even if they might be a little bit, not being fully transparent with themselves about the temptation of doing it. But some people would feel comfortable saying, well, I don't do that. This one is a lot more challenging. So this one I think is a lot more challenging, particularly for any of our folks that have student loans. So practicing tax efficient asset location. Could you talk about that a little bit? What does that mean? Tax efficient asset location.
Yes. So I'm sure everybody on the call has probably heard of, asset allocation, right? All the different pieces of the market that you want to be invested in. You want to have US, you want to have international. Boy, we're going to talk about that in a sec. But where you hold it, what accounts you hold it in is really, really important. So a great example of this is let's take VTI, the US stock market fund from Vanguard, and VXUS, they're everything outside the US fund. Those two are a great foundation for a portfolio. But if you so VTI, the US fund, pays a small dividend, and most of it is qualified, which means it's taxed at your long-term capital gains rate. It's very, very cheap, right? The international fund pays a much larger dividend, and a much larger portion of that larger dividend is non-qualified. And what that means is it's taxed at your marginal rate, right? That's very typical of international funds.
Let's slow that down real quick because of how technical that is. So basically, like US stocks, dividend yield is something like, what is it, 1.2? I forget the percent.
Yeah, it's like 1.1 right now.
div yield. So it's 1.1. International stocks, the dividend yield is what? 2 point, what is it? 2.7 maybe right now, something like
Yeah,
that.
2.7. Yep.
Okay. So 1.1, 2.7. Why is the international yield, dividend yield more? Generally speaking, I think it's mainly because like international stocks, I think because of like local laws are required to distribute more of their gains as dividends versus like share buybacks, which is more the US system, if that makes any sense, right? International stocks just have a higher realized yield of income every year. And what that means is more taxes, is what you're describing, right? And in
Hmm.
the US, dividends can qualify for preferred tax treatment. We say that's qualified, right? And so just to translate what that means, the qualified percentage of that dividend yield in the US is something like 92%, right? So something along those lines. And you're saying that
Hmm.
the international dividend or the international qualified dividend yields are something like, what was it? I think you said 72
Yep.
or something
About
along those
72.
lines. So what does
Yeah.
that mean? It means that 92% of the US dividend yield is going to get taxed at like low capital gains rates. But you know, most of the international gets taxed at preferred rates, but a significant chunk, over a quarter, gets taxed at marginal rates, which are super, super high. And then for, interest income, this is obviously even worse, right? So for interest income, if you're talking about a bond that yields 4%, you might be losing, 32 federal, 5 state, 15 for old IBR, 3.8 for ACA tax. You know what I mean? I mean, it just
Hmm.
adds up and adds up and adds up. And before you know it, you're at like, 50 to 55% of your interest income that's lost, right? So the idea behind this asset location is what we do in our portfolios. I'll pause real quick just to pull up a different sheet. So what we do in our IDR sensitive portfolios for clients is we put more US and growth stocks with lower yields in brokerage where they're taxed, but they're taxed at lower rates and they lose less to taxes, right? And then we put more value in international in our retirement accounts where the higher yield is not doesn't matter as much because you're not losing as much to taxes because it's in this tax deferred account, right? But the overall allocation makes sense. The overall allocation is roughly 60% US, 40% international. But we've got that split into roughly like 70-30 US in brokerage and 50-50 in retirement because of those tax efficient asset location strategies, right? And I think most people don't do this. I mean, that's just reality. Most DIY investors are not thinking about um, tax efficient asset location. That's not something that people think about, or if they think about it, they only think about it in terms of not putting taxable bonds in their brokerage, and that's all they think about, right? But most
Right.
people are making a mistake with that.
I think another helpful way to boil this down is you've got good dividends and you've got bad dividends. Have as much of your good dividends as possible in your taxable brokerage account. Have as much as possible of your bad dividends in your retirement accounts. That's what we do automatically for clients.
Yeah. And if people are using other kind of passive managers, like they don't customize portfolios to student loan borrowers. Like they're one size fits all. They're not taking into account that a lot of people are losing an extra 10 to 15% of their income from IDR, and therefore having extra dividend yield and interest income that's taxed is not a good thing if you're losing 10 to 15% of your income to an IDR plan. That is extra tax inefficiency. So it makes the importance of asset location even greater, right? It's even more important to do good asset location and build portfolios in a really, really, really customized, smart way when you are losing 15% of your income to IBR, or 10% even. Um, Now, those are the ones that we think that maybe some people would be okay with, like maybe, right? Like that's in the maybe category. Let's and by the way, what was the Halloween character for this one?
Hannibal Lecter,
Oh
very
gosh, that's
particular, very
terrible.
organized, very
Oh
detailed.
gosh,
Sorry,
that's
that's it.
creepy. I don't
Yep.
like that.
Yep.
Oh gosh. Okay.
They get scarier
So
as we go.
so let's go down these last four and then I want to make sure we take people's questions and the goal is to get through this really quickly and then get to the questions to reward the people who show up live. Um, so so this one right here, engaging in tax loss harvesting, right? So most people say they're doing this and they're not, right? So from my experience looking at DIY accounts, almost no one is doing tax loss harvesting. If you ask them, they will say yes, but it's because they did it once. So tax loss harvesting for a human to do is really a pain in the butt. right? Because you're having to think 30 days before, 30 days after, make sure you don't violate the wash sale rule. I don't know, probably 1% of DIY investors are correctly tax loss harvesting. I mean, it is a tiny, tiny number. The
Right.
the annual performance impact estimate on this, 0.85, we sourced this from this MIT tax loss harvesting study. So if I pull this up, essentially it says, that it's 1.1% performance impact in the period they studied from 1926 to 2018. But when constrained by the wash sale rule, which limits the opportunities to do tax loss harvesting because of the 30-day look back periods in either direction, that reduces the performance value. I guess it's 0.85, not 0.82. But I said 0.85. I was right. Look at me. Go me. Haha. But basically most people are saying they're doing this and they're not. A lot of people that might think that they're doing this, if they're using some sort of like passive robo-advisor or something, are possibly messing this up because you're not looking across the entire account. You don't want to have total U.S. stock market in your retirement that the robo is not managing if you're also tax loss harvesting on the total U.S. stock market in your brokerage account, right? So like this is one that most people, if they have a brokerage account, they are not doing it, right? And that's a significant loss. And why, I guess, Connor, if I was trying to explain this to a client about why is it important to tax loss harvest, eventually you're going to use your money, right? Or in some capacity, most people are going to use their money in some way, right? And if you have tax loss harvesting over time that builds up big losses, if you ever sell something for a gain, you can take all those paper losses that you've accumulated and then write off gains against the losses and not pay tax. So as a transparent example, like we're thinking about, buying a vacation home right now. We're wanting to liquidate some stocks to do that because I've tax loss harvested. I've got some losses that I could use to offset, gains. And that actually segues perfectly into this cost basis one for the next item. But real quick, who's the Halloween character for tax loss harvesting?
Tax loss harvesting is Frankenstein because it requires a lot of work, and he was made with a
Yeah.
lot of work. I had tax loss harvesting is, if you are really, really intentional about it, it could be done, but it's a nightmare to do. Like Vanguard got rid of specific identification of shares, which is so important, right? Because when you tax loss harvest, you're choosing individual tax lots to sell, right? You have to be
Yeah.
very particular. So it's so difficult. And the other thing is the time, the consistency that you need to execute it. Vanguard's study on tax loss harvesting says it's worth similar, like 1% on average. But that's if you do it all the time. If you change that to doing it quarterly, even just quarterly, that value drops to below 0.5% a year. So
Mm.
the value is ongoing. You check it every single week. That's what I guide my clients if they're going to try DIY investing, that you have to be checking and have to have this systematic every single week.
Well, out of fairness, though, I mean, like if you have a really bad week in the market, like that's kind of a time where you might go look at it versus like needing to check it every day if the market's not moving a whole lot. That's, it's probably okay to
Sure.
not pay attention to it. But
Right.
that said, you might be on vacation, right? You might be at your brother's bachelor party at the time that the market falls all over itself, whatever. I mean, I'm just
Yeah.
making up stuff, but like
We hope you're on the
scenarios.
beach having a
Yeah, well,
little umbrella in your drink.
so let's talk about this cost basis one. This is, I think, the most shocking to even the most hardcore DIYers out there that they don't know about. And that is the default cost basis method for investments at all the major or a lot of the major investment companies out there. So folks are aware, if you have just a regular brokerage account at Vanguard, they're going to take your mutual funds and they're going to use average cost. What does that mean? It means that over time, if you invest 1,000 a month for 10 years, they're just going to look at your total gains, over the whole portfolio. And if you go sell, 10 shares, they're going to calculate just the average gain across the whole position. And you're going to pay tax on, that average gain across the whole position proportionally to what you sell, right? That is horrifically inefficient from a tax perspective. Why
I
did they
feel
do
like
it
the
that way?
psycho noise should be playing right now.
Right, is terrifying. I mean, because it's the easiest way that DIYers blow up their performance and don't even realize they did it. And and I think this is, even if you think that you're in great shape and you don't need any, this is something that if you ever use your money, you will very likely blow yourself up on if you are not aware of it. Um, the the average cost is for mutual funds. For ETFs, exchange traded funds, that's going to be FIFO. So that's first in, first out. So what that means, the reason they do this is because this is like the IRS default. So this is like the safe method for the brokerage to select that doesn't get them in trouble with the IRS, because the brokerage firm is required to report to the IRS at the time of sale, the method of cost basis and how you did this, how do you do your transaction. And the reason is they need to be able to report without having to go back and changing a bunch of things to the IRS, like what the gain was, because it's tax. If it's a taxable account, it's taxed, right? So average cost, again, is a horrific cost basis selection. Average cost is only suitable for somebody that's got like 10 grand in a mutual fund. I mean, that's it. And the thing is because it's the default method, almost nobody switches out of it that I've seen. Like most people that are DIY, even people who have 6 figures in their accounts or even 7 figures, have not switched out of it. I saw some very DIY physician on one of the investment forums or Facebook groups once telling people, hey, I've got a great recommendation. Everybody needs to be switching their mutual funds over to ETFs. At Vanguard, you can just do it without a tax consequences. All you got to do is just request it. And it's a great move, right? Because ETFs are so much better or whatever. And I was like, I just asked the guy, I was like, are you aware that locks you into average cost in your ETF position? Like, are you aware it does that? Because now when you do that, unless you've got, a different cost basis method selected on those mutual funds before the transaction, you're locked into that. You now have an average cost that you cannot change forever and always. And this guy is like hardcore DIY, thinks advisors are a scam and stuff like that. And it's like, you're giving out advice that could cost people way more than an AUM fee, way more. And it's because people, I think, have overconfidence bias and they don't know what they don't know. I mean, I'm not trying to be salesy. I'm just trying to be honest, right? Like I think people are very smart people are very susceptible to overconfidence bias. So for ETFs anyways, first in, first out, what is that? That's basically like when you go and sell, the first thing you bought is the thing that they sell. That's even worse than average cost. So that's because usually the first things you buy in a series of long-term investing is like the lowest cost investments that you bought forever ago and has the biggest gains. So if you don't change that when you go and sell and use your money, you're going to incur tons of extra taxes that you don't need, right? So I think that's I don't know. I mean, I think that this is the one that I feel the most confident that like this one thing alone pays for somebody managing your portfolio if you're not watching it like a hawk, because most people mess it up. Who's the character for this one?
Michael Myers, because he's always hiding. This is one that stays hidden. Like Travis said, it stays hidden until you go to use your money, and then you realize, oh crud, I'm locked into average cost at Vanguard, and all of a sudden I have a massive tax consequence for selling. So
right,
always hiding,
and you don't realize it until after you realize, oh, I could have done something differently, And so then this last one is more of a risk reducer versus a performance enhancer. There is some performance impact of regularly rebalancing, but let's just make it simple. Let's say you had 50-50 US and international stocks. One asset class is going to run hotter than the other, and it's not going to be predictable as to when that's going to happen. When that happens, you want to keep that overall allocation similar to what your allocation is supposed to be in the investment policy statement. And if people are not doing that, then they're exposing themselves to extra risk that they don't need to be doing, right? So that's like, that's not helpful. You're basically, by doing rebalancing, you're selling high and buying low because you're putting more into investments when they've done poorly, and maybe putting less in investments when they've done really well to keep that target allocation, whatever it's supposed to be in the investment policy statement.
And that sounds easy to do, and it's so hard, right? Because take this year, for example, international is beating US by a landslide, right? By I think over 12%, we found as of today.
Yeah, we can look at that in a second. We can look at it in a second. But yeah, it's a big, I mean, it's tariffs, right? But we'll talk about that in a second. The last thing I'll say, oh, sorry, what was the Halloween character for that one again?
That is Pennywise, because it changes shape and you have to bring it back to its original form. Yeah.
That's terrifying. This is a truly terrifying webinar. All right. So if you're married, the last one doesn't have a specific quantifiable impact that I decided to put down there, but it is very much true that tension happens in relationships over investing. A lot of times one spouse will be the more financially engaged spouse than the other, and the not financially engaged spouse has a lot of questions. Hey, why did you invest so much of our holdings in Doge? Why did you? I'm just joking about that one, but why are you picking, whatever? Why do we have so much in NVIDIA? Or why do we have, And the thing is like, even if it works out, um, it can work out not great from a personal life perspective. And I don't mean that in a you shouldn't have agency in your own decisions in your portfolio, but it's just a true statement that money is a big source of stress in relationships. And sometimes there's some value to be added in just having somebody else who is independent, a third party, a disinterested party that's able to have both spouses understand what's going on, why, making sure that this is going according to the overall goals of each spouse. It's a attention reliever, you could say. So that's the seventh, and I want to get to some questions. But what's the Halloween one for this?
Didn't make a Halloween character for this one.
That's all good.
That's scary
So
enough.
the way to think about this overall is which ones, if you're very honest with yourself, are you probably not going to do, right? So let's say you're investing in a low cost way, you'll select yes. Are you avoiding market timing? Most people are going to have to say no if they're honest about it, but let's just say yes. Tax efficient asset location, most people are not going to do that. Tax loss harvesting, most people are not going to do that. Managing cost basis now and in the future, most people are not going to do that. But let's say people do remember to rebalance. So then that could be, in this particular scenario, that could be up to 2.7% per year in annual value before advisory fees, right? And I do think, transparently for us and our company, I do think that we at some point will move to a tiered AUM fee where smaller accounts will have a slightly higher fee than we currently have, and larger accounts will have a slightly lower fee, just because the service has to be economical for the company providing it, right? But I think that the way you should always look at an AUM fee or any fee that you pay for help of any kind is, am I getting more value than it cost, right? And I think that a lot of people that are DIY assume they don't need anything at all. And a big part of this is because of how US stocks have performed in the particular market cycle that aligns with when a lot of Reddit and Facebook forums came online. So maybe we could take a look at that next and look at international versus US and that kind of juicy stuff. So let me pull that up if I can. I think I got it up here. So, Conor, what are we looking at for 2025 performance for US and international right now?
So US is, if you're invested 100% in the US, up 14%. So you're happy. But look at that column D, 26.5%. So everything outside the US has outperformed by 12% this year, which you can just see on Travis's screen right now. Like, look at the past, 15 years, maybe a little bit over 15. All that green means US has been outperforming. So
Yeah,
this is a pretty historic year.
Yeah. So, and if you look at, this historically long term, right? Essentially, if you think about this just at a very, very high level, should US outperform the rest of the world stock market forever? The answer to that mathematically is no, because it's not possible, right? If US outperformed the international market forever, everybody would sell all their international stocks and buy only US stocks. And eventually the US market would be 100% of the world stock market, right? So that's not on the table. So that means that there will be periods where international outperforms the US and US outperforms international. What happens is it's hard to know when these things happen. And since 2008, when most of the investing forums that exist have come online and gotten popularized, US stocks have dominated international stocks over a very extended period of time, right? I mean, in fact, this year, the 2025, is the first year that there was a double-digit outperformance for international stocks since 2006. So our client portfolios have benefited from this quite a bit. But if you look at what happened in the 2000s, well, the international markets were faring better than the US markets, and a lot of it was due to 9/11, right? And the unique impact of 9/11 on American markets. But then go back in time a little bit more and look at how wild this is. 1980s, 90s, 2000s. There were times in the 80s where international markets weren't just outperforming, they were destroying. They were destroying the US markets, right? And then in the early 90s, US markets destroyed international. Then international had a brief destroying in the early 90s. And then 90s, US dominated, particularly the middle of the 90s, right? Where there was periods where, US markets just trounced international. So the thought process behind this is like, does international deserve a place in client portfolios? If you look at most, big investment companies, pretty much most of them say an emphatic yes, it does, and we agree with that. We think that international is a significant portion of the global market cap, and we think that client portfolios really ought to have a significant allocation that's called out in the investment policy statement that does not, go away or change because of the prevailing winds of the day. And we did this when it was very unpopular, right? So we made this call in the early 2020s when U.S. market was continuing to just dominate international, and we did that very intentionally because we knew that there would come a time where international would dominate the U.S. and we wanted our client portfolios to be diversified to benefit from risk mitigation of having something that zigs while something else zags, right? And remember that market timing point I made, Connor, about how people have negative impact from market timing? Whenever I see client portfolios that have a disproportionate amount of growth stocks or U.S. stocks, just to call a spade, they're absolutely market timing. They're market timing from U.S. markets dominating international for the past 15 years and thinking that that will continue and that they don't need to have a lot of international because of the past performance of U.S. stocks. So that's a very, very common investing mistake. It leads to a lot of underperformance because what happens is those same folks, if you ever see a period like the late 80s again, where international performs at 65% in a year and U.S. does 15%, suddenly they go from 0% international to 50% international at the exact wrong time, right? So that's the kind of positive impact to having that third-party professional that's helping you think through all these different investment, principles and strategies. It's because we're all human and we're all subject to behavioral biases. It's just true. Another thing I'll call out about our portfolios is we do have not a massive allocation, but we do have a non-zero allocation to small cap value stocks. Why do we do that? Remember I said that we want to have stuff zigging while other stuff is zagging. So if you look at large cap and small cap value, what you'll notice is during periods like the 2000s when the U.S. was having a hard time, small cap value did much better than U.S. large cap, right? Why is that? 9/11 attacks, global large companies with international operations were having to think about all kinds of new logistics, like how do we protect our companies and our factories from terrorist attacks, and how do we and so small value companies tend to have most of their their revenues from a local market, right? It's not really subject to international pressures or economic fears. Even in 2008, small cap value outperformed on the compared to the U.S. large cap market. And so we just think that it's wise to have different allocations to asset classes that zig and zag at different times to have good portfolio construction.
I think those same time periods too, Travis, it's important to point out that those large companies move very slowly, right? So when a shock happens, they need time to adjust, right? Supply chains need to adjust, and large companies are slow to take action. Small ones are quick, right? They'll adjust fast. They can move their supply chains quickly. So that's why in times of a lot of shock, I think you'll see small cap value be really valuable.
So let's maybe call it there to see what kind of questions people have. I want to say this, right? Like we at SLP Wealth want to ultimately do what we think is in your best interest. Some people enjoy investing so much as a hobby that they just always want to do it themselves, no matter what the performance impact is. If that's the case, it is what it is, right? Like that, you're the person that's in charge of your money. We really respect that as a sacrosanct value, right? But at the same time, we're not doing our job as fiduciaries if we don't call out when we think a client is hurting themselves financially by not making certain investing mistakes, and also maybe not turning something over when they should. You don't have to agree with our assessment, of course, but I do think that the vast majority of our clients are much better served from a financial ROI perspective, having us just manage what's appropriate to manage for you, right? So Connor, in my mind, that is anything that is not your 403b account at work or your 401k account at work that, we're not able to charge a fee on that. And so most of the time there's a qualified retirement account default investment option available that's good enough. And so you could have that not be subject to any fees, where we're giving management to the things like the backdoor Roth IRAs, the solo 401ks, where there's a $250 fine if you don't file your 5,500 easy paperwork, right? If you pass a certain asset level. The brokerage accounts, I think one thing we did not mention is a lot of people are messing up their cash contributions to charity. They should be donating shares to a donor advised fund. We're doing this for some clients to get the big gain positions out of their portfolio and giving that to the charity instead of the cash they're doing, right?
Yeah. We're
I don't
saving
know
a
if you
few
want.
clients thousands a year on that. But
Yeah.
that could probably be a webinar in and of itself. We'll chat with you guys about later this year.
So let
But
me honor my
very,
word
very
here
important.
and get to some of the questions. So Ashley's
Yeah.
asking if you're not doing FIFO or average cost, what is the preferred method for selling? So min tax is the least bad, in my mind, but it also depends, right? It also depends on the situation. You have to be confident that they will actually execute that in the right way. It might be, and also the cost basis might be right within the account, but might not be right across your entire portfolio. Do you know what I mean? So like something that might be a correct lot to sell at one brokerage account might not be the right thing to sell overall globally. Do you know what I mean? Because there's different accounts at different institutions. For a lot of people, they have multiple brokerage accounts. Things are scattered all over the place. And the thing is you don't have to just change it one time either. This is not a flip a switch and you're good forever. This is you have to constantly monitor this so that every time you use your money, you have to be, and this also, you can get locked into a bad cost basis when you do a tax loss harvest trade, right? So if you go in and you do a tax loss harvest trade on, on something, that can even lock you in, I think, sometimes. So it's just like cost basis is something that if you're going to DIY it, you have to constantly manage it. It's just reality.
The min tax that Travis mentioned is at Vanguard. So that's one option, and it
A
is
spec
tricky
ID is
to
another.
align. Yeah, at any other custodian, if you have the option, you want specific identification of shares where you actually choose the individual tax lots that you tax loss harvest or you rebalance, right? Min tax is good, but it's not without its faults. And tax loss harvesting with min tax is very tricky, but that's for another time too. Hopefully that's helpful. Yeah.
Yeah. And I'd love to get um, politely skeptical questions. If you think that you are not convinced or you just have some more further questions, you don't have to be skeptical. It just be questions in general. I would love to get some of those as well. Because I think that, one of the things that I've noticed is so I've noticed this across our planners, honestly. I think some of our planners are concerned about feeling salesy. Like we hire people intentionally that are not salesy, that are servant's heart people that want to just really just pour out of themselves to their clients, right? And I think sometimes our planners are a little bit too polite when it comes to, as a fiduciary, calling out like, "Hey, client, you are very likely costing yourself money." Like, "Hey, client, is it okay if I rip you a new one?" Like, you're costing yourself a lot of money, right? It's not kind to not mention this sometimes, but I think some of our planners, and this is not me throwing planners under the bus, this is just me saying that I think it's human nature to not want to be confrontational. And so I'm, in some ways, I wanted to do this webinar to be the bad guy and call out that I do think that, we have a big, several hundreds of clients that are using us for investment management. And then we have some clients who are not. And my goal in this is to say, okay, if you're going to manage your own, that's totally fine. We want you to be aware of having to monitor all of these things, right? We want you to have to monitor all these things to make you're doing the best job you possibly can with your portfolio's performance. And if you're not doing these things, if you're not doing enough of them, you're very likely costing yourself a significant amount of money, right? So I don't know. That's me. That's
Yeah.
the most controversial hot take of the day.
Yeah, I love that. Give us your skeptical questions. Also let us know, out of those things that are on that sheet, what are you having the most difficulty with? What have you found the most challenging at, if you're managing your own investments, that is.
And of course, if we don't get any questions, we'll just wrap it up early. I think the next time we do this, I think we might try to do a live chat. Like I think these SLP Wealth webinars are typically a lot smaller than our SLP webinars because of the number of people it goes out to. So we want to experiment with whatever you enjoy the most and find the most value in. We debated whether or not to do this as a live meeting instead of a webinar. But I mean, I think it's been fine, but I think that maybe the next time we do this, or maybe the time after that, we might try to do like a group client conversation and facilitate that. Just, it might be a little bit more fun to get people's, like, if you're just talking We're just two guys, right? Two guys that,
That didn't want to break Zoom.
well, yeah, exactly. So we got a question for rebalancing. Is the goal to deposit more into the fund that's lagging as opposed to selling the high fund? Yeah. So think about it. I'll give some more like kind of math examples here. So let's say it's the 90s to use an extreme example, right, Connor? So um, let's say you invested like $50 um, into each US and international in the 90s, right? So 50 US, 50 international, and let's say you left it alone. Um, so this is not entirely right because I'm just doing this very quickly, but so if we kind of do US and international, so we started out where US was 50% of the overall portfolio, right? And so when you are not rebalancing over the 90s, your portfolio became 2/3 US when your investment policy statement accounted for half US. And what that did is expose you to more risk. Why? Because then what happened is that after the 90s, the 2000s happened, and there was a 6 year, I think that was 6 year underperformance of international versus US, right? So essentially your overall allocation probably drifted um, back to closer to 50/50. Let's see if I can put some numbers in here just for fun. So you see how your overall allocation drifted back towards, it got as high as 69% and then it drifted back to 60. So in other words,
Can you zoom in a little, Travis, for those of
yeah,
us knocking
yeah,
on the
yeah.
door to
Yeah,
glasses?
so your risk adjusted performance was much better if you just, you know, in an intelligent way tried to put a little bit more into international when it was underperforming to get that overall allocation to the right overall level. That's the idea behind rebalancing. And so the problem is if you go set up a recurring contribution at a place like Vanguard, it's not going to do this for you. You have to either adjust your recurring contribution, or once a year, you kind of need to go and make a big lump sum contribution to one fund or the other. Is that worth your time? Probably not. So that's the idea behind the rebalancing. And that's why I said from a perspective of performance, since you drift back to a better allocation over time anyway, you're not necessarily adding a huge amount to performance, but what you are doing by not rebalancing is adding a ton of extra risk to your portfolio and volatility that you don't need. So hopefully that made sense.
I'll add on, Ashley. I think it's the answer is yes, right? And also it depends. Because if you could rebalance through contributions, but sometimes that'll be too slow. And the times that it'll be too slow are the most important times to be rebalancing. That's when it's most valuable, right? When the market's
So
moving fast.
Leslie, yeah, and Leslie's got a great question, and this is one that is a personal a good question for me. So she doesn't want to give every other year, because she's read that giving through donor advised funds is so clunky. You have to give very sporadically because how bad they are. I will tell you this, one of the reasons we started SLP Wealth is because we wanted everything we do to have exceptional customer experience. That doesn't happen overnight. For those of you that started at the very beginning when we founded SLP Wealth, there's been a lot of process improvements and a lot of program improvements and things that we've done from now until back in the day, right? One of the things that I've realized that we're starting to do is a solve for this question that Leslie has. So I've done this for my own personal tithing. So like what I do is I donate quarterly a large sum from my portfolio to my donor advised fund that will more than cover the monthly donations that I have scheduled to go out to the charities that I want to give to over the course of the coming 3 months. So I have a calendar reminder every 3 months to go refill my donor advised fund with my stock shares. And then I've set it up with the donor advised fund where it just automatically, without any work from me, goes out to the charities, right? and it goes out on a monthly basis because every charity basically really loves monthly support because they have monthly bills. And that, if you've ever had somebody that's charitably trying to fundraise, they all love the monthly pledges because of their expenses being monthly, right? Um, and so this was transformational. And my wife had questions about this because she's like, Travis, I don't want us to be less generous. This feels like a tax cheat or something like that. Like, I want to make sure that we're being more generous. And I was like, all right, we're going to make it a win-win. I'm going to give more money than I was giving to the charities through the donor advised fund than I was giving with cash, and I'm saving way more in taxes doing it. So it's a win-win. And the reason I wasn't doing this before is because, in my opinion, Vanguard Charitable, Fidelity Charitable stink. The interfaces are old. They're built for 70-year-olds, in my opinion. And it's being recorded, so I better need to say, in my opinion, I think that the donor advised funds for these other organizations are really not user-friendly. And what I use is a company called Daffy, and I believe we use that one, Connor, right? Or we're working with the best ones out there, at least for our clients that we're doing the DAFs for, right?
Yeah. I can talk to this a little bit too to answer Leslie's question. You can also, you don't have to tithe into a donor advised fund. If you want to, most organizations will accept direct donation of shares. So that's, for some of our clients, that's what we're doing right now. We'll do it multiple times a year and send shares directly to the organization. There's a massive tax benefit in that. And you don't have to give up the cadence necessarily. You have to, if you're giving, let's say monthly, we're not able to do it monthly, but you can still do it several times in the calendar year, right? So you don't have to give up your cadence too much.
Well,
You
you're
don't have to
talking
make
about
it
if you do you're talking about if you do the direct donation of
hmm
stocks to the
Right.
charity, right? And so I guess what I'm saying is there's many ways to do it. It's a
hmm
great opportunity to talk through with your advisor if we're managing your brokerage accounts. What is the best way to do that, right? Now, transparently, if we're not managing your brokerage accounts, that would be investment advice to tell you which share lots to donate, and therefore that would be something that you would have to figure out on your own. But that's, again, like one of the realities of investment advice is if there's value, like it's worth paying for because you're getting value, right? And so I think that for anybody who's charitable with a significant brokerage account, that is one of the easiest ways to add a ton of value to somebody's situation is, if you want to make sure it's monthly, then you can look at different options, right? You can look at Daffy, you can look at direct donation. There's all kinds of ways that you can do it that are more tax efficient than giving in cash. Because what that does is, let's say you're giving, you pick a big number. Let's say you're giving 50,000 a year to charity, right? You're just getting the deduction for the donation if you're itemizing. That's just the cash. Whereas what you could be doing is getting the biggest gain stocks out of your portfolio. And then what you're doing is when you eventually use some of the money in your portfolio, you're using 50,000 of stocks that you invested with no gains, when you've invested them, because the cost basis is much higher. So it saves you thousands of dollars or even more than that, and tens of thousands potentially in taxes by doing this.
Yeah.
Let's look at the Q&A. I
We
think there's a couple Q&As maybe.
we have two. We have two. I would love, Travis, to hear your thoughts on Nolan's question, if you want to read
Yeah.
that one.
Well, so since 80, off the top of my head, it's probably going to be the US was better, but let's just see live because I don't have the off the top of my head answer to that. But the problem with that is we're asking about a very specific time frame. Does that make sense? So like if we pick a different year, it very well yields a different answer. You know what I mean? So I think that's the problem with looking at it like this. So let's see here. Let's just see what it says.
While you're working on the numbers answer, Travis, I can conceptually, I think so. So the way that we've approached this is, if you look at the total developed stock market of the world, the US generally accounts for about 60% of it. And Travis mentioned earlier, if the US goes on an absolute tear, can that continue indefinitely? It can't, right? Because the US market will become so expensive that there would be so much attractiveness investing outside of the US that money would naturally flow there, right? So I think approximating the way that the world looks is a smart strategy long term, because eventually there's reversion to the mean, right?
Well,
But
yeah,
Travis is working on that exact number.
and looking at, exactly at 1980, if you invested only $50 at the very beginning of 1980, I mean, the answer is you wouldn't want to have anything in international. You would want to have everything in the U.S. stock market. And why? Because that particular time was very dominant for U.S. equities. You had the roaring 80s, the roaring 90s, and then the roaring, post 2008 to 2024. But what matters is not past performance. What matters is valuations today and what we think the projected returns are going forward, right? Like if U.S. equities are 2 or 3 times as expensive, I have to pull up the PE ratio, but if they're significantly more expensive than international equities, you can't invest only in international in U.S. thinking that the world's going to look exactly like it did from 80 to 2025. If I put in 70 like as a starting date, just to pick a different number here, just for fun. Let's see what that is. So the gap is less, but the other thing is what if you consistently invest in both? I mean, so I think that the key thing to think about is when you start this matters a lot, right? So if I start this in 85, it's going to be a different result. You know what I mean? Because that's right when you had a big boom of international. So I don't think it's easy enough to say, well, the US markets have dominated the past 20, 30, 40 years. I mean, the other thing to think about, in terms of bonds, right, is in the 80s, my grandfather was investing in 15% US treasuries, right? And then 15% yields dropped all the way to nothing and bond prices soared. Can I go invest in US treasuries at 15%, and expect bond returns that are going to be double-digit percentages? No. The only way you get double-digit returns on bonds now is if you have a Great Depression and deflation. I mean, so you have to look at math, and you can't just look at past performance and only look at past performance because, we're always required to say as a SEC registered advisor, the past performance is no guarantee of future results. The reason that we're required to say it over and over and over again, partly is legal and compliance stuff, but it's also partly because it's true, right? You have to build a portfolio that can weather whatever the world looks like. Who would have predicted all these tariffs were going to happen, right? Who would have predicted all of the kind of dislocation from all the different kind of trade wars that are going on? So every year looks different, and if you don't think about a long-term allocation you can stick with through thick and thin, that's what matters. Let's see. Yeah, here we go. So, yeah, so here's a good question from Matt. Appreciate Matt doing a question that's like, entertaining us, entertaining the desire for a skeptical question. So he says, could you show like a cost benefit analysis to how much money would have to be earned from brokerage accounts to make the cost of wealth less than what would have been saved by having SLP manage the accounts? Yes, I can. I'm going to pull up the mega spreadsheet, Connor. And then I'm going to go to the menu, and then I'm going to go to the financial advice calculator. Or financial advice calculator. So what this does is it looks at what you're investing in, projected rate of returns and fees, and let's say you've got 500,000 that you're currently managing on your own, and you put 10 grand a year into investments, right? Let's say you're 35, plan to retire at 60. Let's say you're expecting an 8% return. Let's just pick on a 1% AUM fee for a second, right? Let's just say that your advisor is charging you just a straight up 1% AUM fee, and we'll see if there's value or not. So here's the yes/no questions, kind of similar to the other checklist that I just showed earlier, but this is saying, can you identify low-cost funds over time? Most people we said would say yes to that. Now, will you remember to rebalance your portfolio at least annually? Most people are just not going to do this. It's just truth. They're not going to do it. So I'm saying maybe not to that. Now, will you avoid selling or decreasing your stock exposure during market downturns, even when markets decrease by 50% or more? I'm going to go ahead and give that to people, right? I'm going to say, yeah, let's go ahead and say that you'll avoid that mistake, right? So let's just pretend that market timing and is off the table because you do that. But these two ones, will you locate your investments in the proper place based on tax efficiency, based on qualified, non-qualified dividend distribution percentages? I'm going to say most people, maybe not. And then will you always select the right cost basis when selling? Will you always choose the right account, not just within the account, but across your accounts? Will you always pull out money from the right place where you need money to spend? And, an example of that, for example, too, is like, let's say you need, cash to close in a vacation property and you got tons of gains in your brokerage accounts. You can do a margin loan against your brokerage assets to close in cash to avoid realizing tons of taxes, and then refinance the property with a mortgage, right? That's what wealthy people do to avoid taking out a bunch of unnecessary gains and paying tax on them. It's just an example of how the cost basis thing is not a switch flip. So let's say that's maybe not, and will you tax loss harvest? Maybe not. This is more of a qualitative ones. Will you regularly review your spending to identify unwanted or unused subscriptions for you and your spouse? Truthfully, most people don't look at their subscriptions. I mean, I think that, it's not just things like professional services like SLP Wealth. It's like tons of subscriptions that most people have, some of which you get a lot of value from, right? Some of which, you don't. So let's just say that your unused subscriptions per year is $1,000 because you're not checking it on Monarch like we'd like you to. And then here's another qualitative one. Does talking about money and investing add stress to your relationship? Yes or no? Have you ever had a fight about money, or have you ever had your spouse or you have a discussion about like, hey, you want to use this money on buying a new car, but I really want to use this money on renovating our kitchen. And that creates, a fight where it ruins the evening. I mean, I'm just, people don't have to say anything about whether or not that's happened to them, but I'll say most married couples at some point in their lives together have some sort of, unfortunate disagreement about money that ruins the evening when it could have been a great evening. I mean, at a minimum, right? And so what would be the amount of money that you would pay per year to avoid those money fights if they happen? Some people are going to say, I have the perfect marriage and I never fight about money. Okay, you can modify the spreadsheet, right? So I just put in that is no, and then let's just say it's just the subscriptions. So based off of not rebalancing, based off of not putting the right investments in the right accounts, based off of not managing cost basis and not doing tax loss harvesting, but identifying the low cost ETFs, avoiding market timing, based on that combination of behaviors, based off of Vanguard and MIT research, the projected impact costs you over 2% of your portfolio. And so the way we model this is we say, well, let's say this is your portfolio at age 60, assuming you make no investment mistakes at all of these, or you do all of them, right? There's no mistakes. You do it perfectly. That's a $4.1 million portfolio. If you make the investment mistakes we listed, that's 2.7. That is a big drop. That is a big hit to your performance, right? Now, what happens with a lot of DIYers, Connor, is because they're so good at saving, because they are somewhat frugal, they notice this number, right? And they don't have the number of what it could have been, right? And of course,
Right.
if, unless you're managing your portfolio like a job every day or every week, then making no investment mistakes is just not on the table. It's not going to happen. You're going to make at least some mistakes. So here's the idea of, based off these answers, what is a wealth that you would have at age 60 minus the advisory fee, right? Minus the advisory fee, what is that net, wealth? And then, this is just the cumulative, projected expenses of the advisory mistakes. This is cumulative impact of the unwanted subscriptions. Now, here's the cumulative advisory fee over time until age 60. You might look at that and say, oh my gosh, $400,000. That's a massive fee. That's a waste of money, right? And I would to that, I would say, of course it's a waste of money if your advisor, instead of putting you in low fee funds, puts you in 1.5% funds because the bank earns a big profit margin on that. They never rebalance the portfolio. That requires work, which would take them away from the golf course. Okay, we don't want to do that. Market timing conversations, maybe occasionally they talk about that, but only if you call into the office and want to sell everything, maybe then they'll talk you out of it. Do they put the right accounts in the right place? Probably not. That creates extra work and complexity, which takes away from golf time. So let's make sure that the model portfolios look pretty similar. And then, cost basis, maybe they do a little bit of that. Maybe they pay attention to that with you a little bit, but they're probably not tax loss harvesting. And they're probably, kind of not adding as much value as really a client deserves from an advisor, right? So I think what happens is, lost in a lot of our AUM fees evil, our advisors evil, like lost in a lot of that conversation is, of course, there are advisors that are way overcompensated for the work that they do, right? But the flip side to that is also true. Of course, investors are overconfident and think they're going to do things and then don't do them and say they're going to do them and then they still haven't done them and miss out on a ton of opportunities that, from a behavioral finance perspective, we can literally predict with a very high degree of certainty that they will make, right? And so I think that the reality is looking at a fee over time is like looking at the cost of, I mean, I'll use a personal example, like looking at the cost of my son's life-saving medical treatment when he was premature without looking at the value, right? I mean, thank goodness we had insurance. Otherwise, we would have, I mean, we could have been just, I mean, that would have been really bad for even, us having a decent savings, but like it was like 7 figures, right? You always have to, I think, look at the cost of something in terms of the value. If you're not getting value, then of course it's a ripoff. But the reality is people, I think, are very unaware of the enormous value that a true fiduciary manager that is reasonable with the cost should be providing to a client. So the net value added over this 25-year period, in this kind of hypothetical 1% AUM fee world, 900 grand, on a sub $5 million portfolio, right? So again, that's a fee that's earned over 25 years in this particular example. This is not a, one and done fee that you're writing a check for like you would for a big home renovation with a general contractor or something. They might make that in a year if you do a big renovation, right? But I think that's kind of the gist of it is take the mega spreadsheet. We'll send it out later. Look through all of these things. Be honest with yourself about, will I make this mistake or not? And it's not just management within the investments. It's also the accountability of, are you maxing your solo K? Are you maxing your backdoor Roths for both you and your spouse? Are you putting money into brokerage accounts and donating shares to charity instead of just doing cash to charity? It's all those like qualitative things too that are not just, is the allocation being managed well within my accounts? And I think that's what's lost on a lot of people, is a lot of people think because the US market has done well for the past 15 years, and that's when investment forums and advice forums have been prevalent online, they think, I don't need international. Well, the past year proved that wrong. International trounced US because of tariff policy. It won't be the first time this happens, right? And then most people are completely unaware of tax-related mistakes in their portfolio because they don't see them. You don't see the impact, and so you're unaware of it. So you have overconfidence bias, assuming that you don't make the mistake. So I will say this: if somebody wants us to just manage it for you, just talk to your advisor about it, right? Just say, these are the accounts that I'm thinking about turning over. You don't have to turn over everything. You could start with whatever the most annoying account is to manage, right? I think for most people, Connor, that's their solo 401ks or their backdoor Roth IRAs, right? But I think that what you'll find over time is that, that tax loss harvesting and the brokerage accounts and the unified view across how we look at like creating custom IDR sensitive portfolios adds a lot more value than the cost. And, as I mentioned, I do think that our cost is going to change from, to a tiered structure where small accounts have a little bit higher AUM fee, large accounts have a little lower AUM fee, just reflecting, the economics of having to do this work, right? It is a lot of work. It's not just, a lot of people think it's just sipping Mai Tais on the beach, maybe for the high fee bank manager that's doing nothing, but, or doing very little, right? But it is a lot of work to manage client accounts because doing proper investment advice takes a lot of work. And so that's why, we have to charge a fee for that.
Yeah. I know we're past time. I want to address one question. Brooke asked a great question in the Q&A. If you're looking to put money to work in the market right now, should you do it as a lump or should you do it over time? And I think the answer to that is the same as buying a house. When's the best time to buy a house? Yesterday. When's the next best time? Yeah. Today. So if you look, let's assume that we're very unfortunate. We have no crystal ball and tomorrow starts the worst market, right, that we've seen since the dot-com bubble. If we just recreate that, if you invested at the end of 1999, right, you're about to have 3 really rough years that are not a lot of fun. After 20 years, you averaged an 8% return, right? And you had horrific timing. So, even if we're coming up on a bad market, we don't know if we are. It's still, having money in the market is better than having it out of the market. Now, I'll also add the human aspect to it. It's really tough to put all your cash to work if you intend on it on on one trading day. So space it out over 3 or 6 months. But I would generally, not try to do it any longer than that. Is that?
Yeah, and I would probably take a little bit more of a working backwards, high level view of I would say what this person's saying is that they have a lot of cash and they're scared they're going to put it in and they're going to watch it go down by half, right? Tomorrow.
Mm-hmm.
And so the way I would say is, okay, how do we build your confidence? And the way I would think about it is, what do you have potentially that could go wrong in the next 5 years or could go right? Like you're saving for a house, you're saving for a home renovation, you're saving for the vacation home you've always wanted. What amount of cash, like abundantly, do you need to achieve all of those short-term goals that you might have on the horizon that you might want to do, right? I think sometimes people kind of underestimate their wants for the next 5 years, right? Like the new car or the new home renovation or whatever it is that they might need cash for. So I would say make sure that that's locked down with your advisor first. Get all those goals truly properly accounted for in your financial plan. And then once you have excess cash above that level, like you said, put it in the market yesterday or don't worry about the time. Do it whenever. Do it tomorrow because it's like you don't want to market time. You want to just get it in there, not think about it because if you look over the very long term, the answer is if you invest today in 30 years, it's going to be way higher, right? So you don't want to think in terms of like when is the right time to enter. You want to think, I think in terms of like how can you be bulletproof, rock solid with your short-term cash so that everything else you're just dumping in the market, right? And that might be different at different times of your life, right? Certain goals kind of pop up, right? Like right now I'm working on building it's kind of weird, but like a special building for my telescopes because that's my big hobby, right? And it's a little bit weird. I'm a little bit weird, but so we're having bigger cash need. And, a year ago, I didn't even know this hobby existed. I just found these old guys hanging out on the golf course and I found my people, my 75-year-old grandpas, and me. We just hang out, look at Saturn in the evenings, So, you never know. Things will happen. Goals change over time. That's another benefit of financial planning and having a coordinated approach to your investing, right? Is sometimes you might need to change your investment plan because life happens and you find a new hobby or you find a new goal and you want to make some modifications to things, right? So, anyways, really appreciate the conversation today. I think we might do a live version of this maybe next time we do it just for fun to try out some different formats. But thank you so much, Conor, for having this, and thank you, clients, for joining. Conor, you want to say any Halloween sign-offs?
Don't let these scary monsters get you.
And
if you're gonna DIY, keep them away.
Yeah, and enjoy the candy. If you have kids, enjoy the trick or treating. And if you need anything, reach out to your advisor. Thanks so much for watching, guys.
Yeah, thanks, y'all.
Are you ready to unlock financial freedom faster with SLP Wealth? Get high-quality, affordable student loan-aware financial planning and get the best deal for it anywhere that you're going to find working with your own dedicated SLP Wealth financial planner that is able to give you the best integrated advice across financial planning, investments, and tax, along with all the student loan hacks that you need and that impact all other areas of your financial planning. The deal you're going to find here is special just for podcast listeners. If you go to promo.slpwealth.com, you can sign up with a great discount off your first month. That's promo.slpwealth.com.